Hi guys, welcome back to Morant's Rants. Plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. This is Connecting the Dots Part 7. Once again, we're going to dive back into Bed Bath & Beyond because it looks like we found a little bit more the connections between private equity via leverage buyout on the public markets, and even if it was a private owned company, it would be the same thing. It's over leveraging these companies, making them feel very uncomfortable in their positions, and this is the time to do it. When it's very hard to borrow money, you hold them to the covenants that are on that money, and you stretch them thin. And this is what they've been doing to multiple companies in real time right now during this distress cycle that we're in. And it doesn't look like we're going to get out of this to about 2025. That's what I've been reading, been watching, doing a lot of homework on distressed credit and the individuals involved. So this is going to be a deep dive. Guys, this is going to be longer than the normal one. So I apologize now. I know that I was told, hey, you need to do more research. Okay, well, I went and did more, and it got even uglier. So let's just put it out there. This is correct. This is FUD, without a doubt. And I say that because people need to know the definition of FUD. If you don't have fear, if you don't have uncertainty, and you don't have doubt, then you should really revisit what you're looking at. Everyone should know both sides of the coin, of the investment that they have. So when I'm investing into companies, I go and break down every aspect of the business so that I know what the potential outcomes may be. In this case, when I look at Bed Bath & Beyond, well, roll with me. All right, guys, these are the board of directors. Now, I know that in the past, I have shown you direct ties for Joshua here, and I don't really know how to say his last name, so I don't want to butcher it too bad. But he had direct ties to Apollo via his company's Viad, who is run by Apollo as well, former Apollo director. A lot of Apollo directors go into other companies, they hold those positions, and then they put pressure and they make really bad decisions. I don't really understand when it started going this route. I wanted to say in the 70s and 80s, and that's why Drexel, Burnham, and Lambert, that's why they were just so notorious about selling junk bonds to companies and then going in and forcing these leverage buyouts. And it's like these guys are actual criminals, like mafia, allegedly, like the mafia. So the government shut that one down. But from that firm, I mean, it just grew like you've never seen. Like, I didn't even know who Thomas H. Lee was. I knew who Oaktree was. And then you go ahead and look at what Apollo does and everybody who branches off from there, whether it be Ares or Pegasus. And I found more today. So we're going to go off of this, and I want you guys to know the names. I want you guys to pay attention because it's what to avoid. Listen, guys, I don't care what the company does, right? Like, they're like, oh, this company's transitioning, or this company's making a difference, or it's kind of like what was happening with AMC. It's all smoke and mirrors until it's not, right? Until it actually clears up, and then you go, whoa, wait a minute, where'd my money go? So if you're invested publicly into these companies, you don't stand a chance, guys. I have literally seen every single company that these guys are in, the distressed credit investors, and they have sold off these companies via bankruptcy piece by piece, and or made the worst business decisions to be over leveraged. It's the truth. This is not something that's up for debate. It's literally factual. Like, you'll see the bank filings, you'll see the SEC filings, and you'll be like, oh, okay. Like, direct connections to Apollo should be advised. It should be warned. It should be a caution to you. So, and I'll explain. It's not just Apollo, guys. I mean, it's so much deeper than that. But let's get to it. Let's just roll into this, and I want you guys to see it yourself. So we'll start at the top here. This is Harriet Edelman. She's been with Bed Bath & Beyond since 2019. She seemed so innocent when I looked at it. I went into her biography here, and when you look to see what she's been doing, this really doesn't give you the gist of what it is. You actually have to go and search up her history, which we've done. And shout out to the research team. They know who they are. I don't need to say them individually, but there's a lot of people, and they're badass, if you know what I mean. There's just a lot of people out here that are awesome. So Emigrant Bank right here, this is where she is, vice chairman, whatever it may be. If you go look at that company really quick, we can go look at it together. There's a billionaire in charge. It's Howard Milstein. He's here. He's the chairman of the board. He's acting everything. He's a billionaire. He's good. I mean, he invests his money however he wants. But when you look at Richard Alexander, another guy on the board here, this Richard Alexander is the chief technical officer for Cerberus. So when you go look at these guys, go look at who owns this company, guys. Go look who's done deals with this company. They closed the deal right here. It'll pop up right here. They closed a $277 million sale of ABC Technologies to Apollo. So you're like, okay, well, that's cool. Then you go to the next one. You go funds managed by affiliates of Apollo Global Management acquire Covis Pharma from Cerberus. So all the deals they're doing, right? And then I believe it's, yeah, we'll keep going on this side. Well, that's the first thing. We'll stop there because, no edits, no cuts. So yes, they have direct ties within the bank on the board of directors. They actually do deals with Apollo, with other people. So she's rubbing shoulders with the right people, this lady here, Harriet Edelman. And don't worry, I have her picture. We'll look at it in a minute because she's a director over here at Assurant. So she's a director still to this day at Assurant. So when I go over to Assurant, right here she is, Harriet Edelman. This is what she looks like, okay? And Harriet is on the board of directors, but who is she on the board of directors with? I'll show you. These guys, these are all the board of directors of Assurant, okay? And remember when I say there's plants? Somebody right here, Lawrence V. Jackson, who is from New Mountain Capital, okay? New Mountain Capital is where he's been before. Just so you know, New Mountain Capital, and I'll show it to you right here. I know, it's just all a coincidence at this point. You have Apollo veteran Sam O's Mountain Capital raises most of its funds, $650 million. So Mountain Capital Partners, this guy used to be a senior partner with Apollo Management, and now he formed his own fund. But you guys know how how dedicated they are to their original fund, to Apollo. Like Apollo's viewed as the god of it all, and that's just for lack of a better term. And so these guys go out, the minute they start up their own fund, they go ahead and start doing deals with the original fund. Apollo Management has made a bid right here, Pipeline Services Company, last month agreed to be taken private by New Mountain Capital. So New Mountain Capital takes them private, and then Apollo makes a bid at them within the month, guys. This is how it works. There's deals being done via them. Another thing is here, ex-Apollo executive firm offers to buy out troubled energy firm, whatever it may be, and that's going to be Sam O via Mountain Capital Management. So you see the direct ties to Apollo via them, and I'll show you more at Assurant. Another thing that she's doing with Assurant, that's just one tie to that fund, is this guy right here, J. Baxter Carter. J. Baxter Carter, guys, is a former board of directors for GameStop. Okay, and that was via, right here, the NeoStar Retail Group, okay? So that's where he was, and now you're partnered up with him as well. Well, they've been partnered up here. And the reason why that NeoStar Group was trying to buy GameStop, if you guys don't remember, I'm going to show you. I have it here somewhere. It's a good read when I find it. Oh, my goodness gracious. Hey, guys, no edits, no cuts. There you go. But you guys know I have a lot of stuff here. Not that one. Oh, right here. Hello. So as you can see, Apollo Global and Sycamore bidding on GameStop. And the whole point was Apollo was trying to buy GameStop. Okay. And Apollo was making those plans to buy it. They had these guys on the board at GameStop who were willing to sell it, but then it fell through and it didn't work out. And because GameStop just had, a little bit more juice on the table than what people wanted to give it credit for. So at one point, yes, Apollo was trying to buy GameStop, and they had that guy planted on the board. She's teamed up with him over here on it, Assurant. But another thing I want to tell you about this, guys, which is kind of crazy on the connections, I'm going to show you, is it here? No, it's over here. Made the bid right here. Now, one more, right here. So the Solo building, okay, guys, this is Solo building. This is known as 9 West 57th Street. It's a skyscraper in the middle of Manhattan. If you guys don't know, that's the address for Apollo. This is where Apollo offices are. If you go into this building, guys, and you look at who's still there in the building, the tenants themselves, before I even get to that route, I'm going to show you right now. So you'll see Tiger Global Management's one, but that's not the ones I want to see. I want to see this one right here. So the people that left, these guys all shared the same building, and you wonder why they share the same investments. Silver Lake was there, okay? KKR was there. So Colbert, Kravitz, and Roberts was there. Silver Lake was in the building as well. But the craziest part that ties this all together for me, guys, you guys really want to read this, is that this young lady, Harriet Edelman, right here, worked for Avon. Worked for Avon for 29 years, okay? For 29 years, she worked at Avon. That means, and I'll go back, that means that she used to go to work for about 30 years at Avon. Does anyone know where Avon's headquarters is, or where it was when she was with the company, when she was the senior vice president, chief information officer, when she was the senior vice president of global supply chain, president of Northwest sales? You guys have any idea where Harriet Edelman went to work every day? This Solo building here has been the home to Apollo since 1990. She was there as well. They used to go to work in the same building because Avon, okay, Avon products, took up a third of the space, became the major tenant of the building. They didn't leave that building until 1997. That means she went to work every day at a senior level in the same building with all the guys. Mark Rowan, Leon Black, you name it. I know, it's a coincidence. I know what it is. She worked in the same building as Apollo for all those years. And what do I even know about this damn address? You know, what do I know? You guys should just go look it up. I think it's crazy that it just so happens that she was there for 30 years at the same address working. Hey, digging a little deep? Yeah, we dig deep. What's next? The next person that we're going to look at and just, oh, look at this deal for a second. This is a crazy deal, by the way, because as we're talking about New Mountain Capital, LLC, just so you're aware, New Mountain Capital, LLC is allowing this company called Unicheck plans to file for bankruptcy protection. But guess who owns all the debt? Oh, man. Owned by Apollo Management, okay? They own the debt. And so that's the connection that I have between the New Mountain, why you wouldn't want to be involved with anyone on that board over there. But that's just one. Let's never forget, and we won't ever forget, that the Fresh Market, Inc. is directly owned by Apollo. They actually bought out Fresh Market, Inc. When they bought the company, they appointed 2 directors. They already had the chairman of the board put in. He was already there. They appointed 2 directors. Sue Gove was one of the directors. Apollo-owned company, Apollo board of directors, chairman of the board, selected Sue Gove as there. So you don't think she has direct ties to Apollo? Well, we know she does because I showed you that in the last part. And this is Andy Johar. That's who did it, right? Now, I have more. Remember we talked about Holly Edelman and Alex Partners? Managing director, and now she's a CFO for Apollo. The one that the standing CFO, right? Just brought her in. And I don't mean for Apollo, but for Bed Bath & Beyond. Yeah, Alex Partners. I understand it. I understand it all now, and here's why. We'll go to the board of directors really quick. The board of director is right here. Carol Flatton. You remember when she was appointed a couple months ago? And everybody was excited. Everybody was like, wow, she's great. She's tapped. And somebody starts, you know, I don't like it when they just start giving them titles. Like, oh, this is Ryan Cohen's guy. This is Carl Icahn's person. This is, like, that's who they, no, what's the proof there? Because I'm going to show you what's factual right now. It's going to blow your mind. Carol Flatton. Hi, Carol. Are you serious? You worked at EP Energy Corp. Okay, guys? She was on the board of directors at EP Energy Corp. Right here. EP Energy Corp, this is an SEC filing, by the way. They had a departure in director, okay? A director left. Do you know who left? He was previously Mr. Hanna. He had certain affiliates to the board since 2013 by Apollo Global Management. So they took on an Apollo guy and they put her there. But EP Energy Corp is actually Apollo. So it's crazy, I know. But as you go here, Apollo and Elliott team to save up EP Energy stake in bankruptcy. So they buy it out of bankruptcy. Apollo does. Right here in 2020, EP Energy emerges from Chapter 11. Yep, we know they do. This is all tied to the Apollo. If you guys don't know that she's been in Apollo companies before, it gets better. EP Energy creditors failed to halt Apollo-backed equity offering. So they gained court approval to continue its 3.3. So they couldn't halt it. the restructuring plan. And guess who approved all of this, guys? Guess who approves all of this? She does. She agreed to sell it. Right here, Apollo-backed energy files for bankruptcy after struggling under debt buyout. Under buyout of the debt. So previously in 2012, the same thing. More than 7 years after 7.2 billion leverage buyout by Apollo, EP Energy Corp has filed for bankruptcy protection. They let this happen. Guys, I think people have a misconception about putting money into companies. They think that when they put money into companies, that they want to get that money back. That's not what they're trying to do. They can make money on the top of it, on the bottom of it, on the new buyout, bankruptcy court, owning the debt, because it's not what you pay for the company. Or I apologize. It's not what you buy. It's what you pay for it. That's the difference here. So she has direct ties to Apollo and the companies that she's worked for. She just left this company, the EP Energies, and now she's here at Bed Bath & Beyond. No? Am I crazy? Okay. I'll stay crazy. You guys can read all this. You guys can read it all. And then you'll understand why I'm going, like, do not touch Bed Bath & Beyond, and it's not lies. Like, you guys can look at a company and think you're going to get your money back. But look at this. She was there just for, right here. She was there for 3 quarters, guys. 3 quarters just for the bankruptcy. And guess what she used to do, Miss Flanton? Miss Flanton used to be managing director for Alex Partners. It's just, it's painful. It says it right here. Prior to joining Alex Partners, she was managing director at Lazard. Remember what I tell you? I mean, it's set up this way, guys. It's set up for you guys to fail on this. And people think people are going to come save a company out of billions of dollars of debt. And that's not what they're doing. No, warrants and dilution only feed the private equity side of it. It's only going to leverage. That's part of the leverage on LOB. So when they actually leverage them out, I'm part of that. I mean, I'm sorry, LBO, leverage buyout firm. So when they do the LBO, in addition to that, they put people into place that are going to make these decisions, and they're going to make money after the bankruptcy. And you guys don't see it this way. You guys think people want to like save them. Well, what public offering could you do on Bed Bath & Beyond that the public's going to buy? The shares are $1.50, guys. I'm just telling you the truth. Carol Flatten, Alex Partners, and Apollo planted, period. Sue Gove, Apollo planted, period. This other lady, Harry Edelman, she's worked with all the worst of them and worked at the Apollo building for 30 years. I'll leave it at that. We'll keep going, though, because you know I don't stop. I really don't. Like, you guys think that stuff isn't real. We'll go with this one next. Ann Yeager. Ann Yeager has direct ties with Ernst & Young LLP. She's Center for the Board of Matters, executive director, and that's going to be her way in, right? So auditing firm, Ernst & Young is the same auditing firm that does AMC. I apologize. Well, Ernst & Young, we know, is terrible. They've been fined numerous amount of times. Ernst & Young to pay out $11.8 million fines in audit failures. They're terrible what they do on purpose. This is a list of all their penalties. Ernst & Young penalties, $123 million, $109 million, $40 million, $50 million. Plenty of false claims, plenty of accounting fraud and deficiencies. This is a terrible firm to hire, and that's who they brought in. They brought in this individual who has ties to Ernst & Young, and she's on the board of directors. They're setting up this company to fail on purpose, guys. And I don't care. I don't care how many people went in and got out already and left, and the ties to Ryan Cohen, and he got out. It's like you guys are all betting on a pipe dream, and you're putting money in. You're okay to lose. But I'm going to show you guys something that kind of puts it all together into perspective. This is going to be, and I'll show it to you right now. I want to make sure I have the right one. I'll make sure, because right here. Is it here? Yeah. So this is going to be the conference that I would used to look at. This is every year. This is that the conference that I was showing you is here, the Wharton Restructuring and Distressed Investors Club. So all of these guys, okay, get together each year and they do like a committee, and they have brunch and they have lunch and they have wine. I read the whole itinerary, the agenda, I should say. And the keynote speaker this year was John Zito, who's Apollo Global Management. He's partner and deputy chief investment officer of credit. Every year they have a huge distressed credit investor hedge fund in charge of like the keynote speaker wise. The platinum sponsors, Kirkland and Ellis. You guys see Alex Partners. So when you see all these companies, even the lawyers are there, the Latham and Watkins, Lazard. Now these are just the paid sponsors, right? But there's more than that. When you look at this, and I went and looked at every single year for the last 15 years, believe it, they have judges, bankruptcy judges, part of this, because these judges, and as I looked at them, were all part of firms before they became judges. So they're telling you it's okay to file this way. They're showing you ways to work around the bankruptcy. And these restructuring committees, right, that they have, these speakers and sessions, and it's going to happen Friday. And they have 3 speakers on a Friday, right? And you'll have Stephen Tannenbaum. And you know what's crazy? People watch the movie, The Big Short, and they're like, oh my God, man, I want that one to happen. And that's what it is. The truth is, The Big Short, all those guys were shorters. So now when you see them in a distressed credit cycle and they guessed it right, that movie's kind of like backwards in a way. It's like you're betting for the fall of the market. Yes, they bet for it. But in our case, these guys make money when the market falls. So what are they doing now? They had a whole cycle of they couldn't make money. So they're manufacturing those outcomes and they're forcing it to happen. But look at these guys, SVB Global. These guys are, every single guy here is about making money by corrupting companies from within, is from what I can see. But you'll see all the moderators, all the FTI Consulting, KKR, Paul and Weiss, all these names you guys need to memorize so you know that if they're in your company, Alex Partners, you should be running. BlackRock, Centerbridge, these guys all meet up under one roof once a year, and it's like clockwork for them. And I just keep going through it, and I was like, look at this committee from 2007 all the way to 2022, 2023 this year. I already have it. It just finished 2 weeks ago, this whole damn thing. And I can go in there and I can see every speaker. I can see every judge that they have there and that they're highlighting. I have more. Watch this. There's that judge, right? Shannon, Honorable Shannon. How about this one from like a long time ago? Look at this guy. I bet you if I go look in there, Judge Robert Drain, okay? This guy, he was part of a firm at Paul and Weiss. He was partners. He was a partner in bankruptcy department of Paul and Weiss before he got appointed. So he's the one doing the cases, which is crazy. And he did Refco, which I've already read about before. These are all a long time ago because that's what they're doing. And they've been on this side of the table for a long time. These judges are bought and paid for, and that's what this committee proves to me when I look at it. And when they're doing this stuff, it should be, look at FTI Consulting, Lazard. They've all been in the same room, guys, for a long time. Unfortunately, we're well behind. And I looked at all this. I read every single damn person for the last 15 years doing these damn committees and stuff. So my cats are having fun middle of a live stream or a middle of a recording. So I'm not going to edit. You guys know I don't. I'm going to end this by showing you a couple things. One, I'm going to show you a video right now that kind of explains the dedication between the hedge funds themselves, and this is distressed credit investors. I know Bed Bath & Beyond is tied to Apollo officially right now. I told you I would never invest in it. I don't know why people are telling you to do otherwise. You might make some money on a run. You might make some money elsewhere, but on a long like transition, pivot, any of that, I don't see it happening. Definitely not in this cycle. To give you some insight, I know individuals that actually work at Bed Bath & Beyond. They're partners with me as we work, and you know what they tell me? They have no freight. And what that means is they have no trucks coming in. They're actually paying FedEx for their trucks. And he says, hey, one truck will come in every 3 weeks, multiple products, but nothing that it was before. So they're either overpaying for freight and they're not bringing enough in. So they're setting themselves up for failure on purpose, or they just don't have the capital. They don't have the money to actually buy the products, to sell the products. There's a cost here. And it doesn't happen. Like, you just can't cut one arm off. Like, I'm going to shut down all Harmon stores. Well, you just upset how many employees, how many executives, and you did that for what reason? So that you could stop the bleeding elsewhere? No, you probably cut off something that was actually profitable, but who knows? Because it's all masked as in we're trying to consolidate. It's very different. There's moving parts here that they could sell off, and that's why I'm nervous for anyone who's involved in the stock. But as far as saying I'm spreading FUD, guys, I'm repeating back to you whatever's factual here. There are people on the board of directors that have direct ties to Apollo. Direct ties. They were put onto different companies by Apollo in the past, recent past. But now let's go ahead and play these video clips. This is going to be Jason Mudrick, and he's going to talk about distressed credit investors and what it's like. And just watch.
You know, we're involved in these situations all the time now. The fact is, one of the things that we've seen through this cycle is very loose covenants. And when you have loose covenants, you know, you're going to get companies that are going to be creative, financial sponsors that are going to be creative. And at the end of the day, what's happening in these situations is companies have figured out a way to extend the optionality in their equity. And oftentimes that involves, you know, treating one class of creditors differently than the others in exchange for liquidity. Right now, liquidity is paramount. So if you're willing to put money into a company, and the company can move you ahead of similarly situated creditors in exchange for getting that money, like, the company should do it. I think as an investor, you just need to understand that risk. You need to handicap that risk. And you know, if not, you're going to wake up on the wrong side of a trade like that.
Well, Jason, thanks so much for joining us. I want to give Troy one last word if he has any more comments or questions for you before we let you go.
Yeah, thanks, John. Thanks, Jason, for being on again. Once again, when you compare it to the 2001 to 2004 cycle, 07 versus through, let's call it 2010, 2011, do you think the return potential is equal or greater now, or do you think it's more compressed because of Fed policy intervention? How do you see it playing out?
I think this is the mother of all cycles in terms of the size, right? I think you know, we're in effectively a zero interest rate environment. So I think the sort of tailwind for equity markets over the next 5 to 10 years is not going to be what it was coming out of the 01 cycle. But there's, you know, the market is, you know, 15 times larger, right? So there's just, if you ask me, would you rather have a bull market or a lot to do? I would say I'd rather have a lot to do. So I'm both.
There you go. So he'd rather have a lot to do. That means that he thinks this market's going to keep going the way it's going right now, because if it's a bull market, he doesn't make any money. But he makes money off the bear market. He makes money off the distress cycle that we're stuck in right now. And this interview was done 2 years ago. We're still in the cycle today. You're going to be in it for at least 2 to 3 more years. So if you're investing for companies for turnarounds, you have to wait and see where they're going to spend their capital. Now, I'm going to show you something. This is Searchlight CEO and director. His name is Eric Zinterhofer. He was original Apollo Partners. I'm going to show you his whole story. I'm going to give you 2 clips here, maybe 3. I see 2 for sure. But let's go ahead and hear it right now.
Great. So let's take us through the beginning part of your career. As you said, you had the opportunity to work at one of the all-time great institutions in Apollo during its most formative years, right as they were just about to experience explosive growth. So what was it like? And just take us through some of the sort of the early experiences and early deals before we get to Charter. I'm going to want to take a deep dive into Charter.
Yeah, sure. You know, I think, you know, just one precursor before we get to the deals. What was great about Apollo for me, and, you know, what we really think a lot about at Searchlight, because we are smaller, is mentorship. I had 2 mentors at Apollo who made all the difference for me. In the early years, it was Rob Katz. He's now CEO of Vail Resorts. For those of you in the audience, look at Vail Resorts stock price over the last decade, under Rob's leadership. He's an extraordinary leader. Vail Resorts was a long-standing portfolio company at Apollo, and he ultimately left to run it. My next mentor, who I view as maybe the most brilliant investor that I've been around in my career, at least in person closely, is Mark Rowan. Mark's now, as many of you know, CEO of Apollo, and I had the privilege of working with him for many years. So that was, to me, one of the key elements of my learning and subsequent success at Apollo. The other dynamic, which I think is relevant for you today, is just the time period in which I joined. So I came out of business school. This was in the 97, 98 period. We know, maybe some in the audience won't know, you guys were quite young at the time, if not, maybe not even born in certain instances. The internet bubble was at its apex in the late 1990s. And some of the things that we're seeing today, if you look at like a Lucid market valuation, which was taken public by a SPAC, take a look at that. There were things like that in droves in the late 1990s.
So what he's saying is the cycles that went through when he got in, they were amazing because he had all these opportunities to take, okay? Now, these guys, and I'm going to show you because I'm going to move to the point because I remember I watched these whole damn interviews while I'm playing League of Legends, doing my best. And that's why I was at 1.5 because I'm listening to everything. But let's go.
In those first few weeks, and my sons can attest to it. I was just sitting in my
how you've
dollars into a business that we're pretty sure is worth 500 million to $1 billion, but even if it's definitely worth 100. We've got a good PIK return. And if the company hits their plan, we'll still make 3, 4, 5 times our money. But maybe we're giving up, making 6 to 8 times our money on it in return for seniority.
Here you guys go.
That's where good structuring and a good understanding of stress scenarios can really help on the growth side, and we've benefited from that.
What an extraordinary pivot, almost Netflix-esque how you've repositioned the fund over the last few years. Piggybacking on the last part about being a good distressed investor, let's talk about last year. So let's talk about how Searchlight, the mindset of Searchlight as COVID hit, and when did it dawn on you that we were in this for the long haul, and how did you once again reposition the fund to survive and in fact thrive during that environment?
That was such an extraordinary period, and as I was confounded in those first few weeks, and my sons can attest to it. I was just sitting in my, out in my home office, and I wouldn't leave it, from 7 in the morning till 11 at night. And what was confounding for me was, might surprise you, because in some ways we anticipated the crisis. We actually, which I doubt many private equity firms did, we actually put a hedge on our second fund where most of our portfolio was, in advance of this crisis really hitting, because, you have these liquid positions. It's not as if we could sell them, and we were worried about what happened. We made pretty good money on that. And so we should have put a bigger hedge on in hindsight. But, we were seeing this coming. And when the crisis hit, we said, okay, we know we're going to have to triage in parts of our portfolio, but we have a new fund, $3 billion fund, which is largely uninvested. We know what to do in this situation. We've been here before. So we just said to the firm, we're focusing on credit, get ready. This is going to be a massive distress cycle. This could be worse than 08, 09. This is a global pandemic. And I'd say about a week and a half, 2 weeks into that, the Fed flashed $6 trillion in front of everybody. And we were just shocked by how quickly the Fed moved. I think insiders were shocked with how quickly everybody moved around this.
So what he's saying is the whole market should have collapsed. These guys should have made billions upon billions upon billions, but that the Fed and just brought out $6 trillion. They just printed money. This is all of the stimulus packages that you got. You saw the whole government keep this economy afloat during the pandemic. These guys should have cashed in, and it could have happened. But if that would have happened, what would have had? Mass hysteria, right? Will we still be here today? But they stretched it out. So from 08 to now, I'm telling you guys, it's the biggest bubble you've ever seen. But when it pops, and it officially pops, certain companies will thrive. And that's what they're telling you. But let's go ahead and listen in a little bit longer. And I'm sorry for these videos being so long, but guess what? You have to hear this from the guys themselves, the guys who lived it. These distressed credit investors are making billions of dollars.
And so we're now in a situation where, you know, it was great that they flashed $6 trillion. The economy was still a mess. You're still in the middle of a pandemic. Nobody really knew what was going on. But a lot of the easy pickings in distressed went away.
Yeah.
And so
the easy pickings in distress went away. That one of those would be GameStop. Okay. They thought it was an easy picking and it went away. Pay attention, guys.
We had to pivot very quickly, and we basically, led by actually one of Darren Glad, who was a partner at Apollo with me, who did the charter deal with me, and Tom Hendrick, who's one of our senior guys in the Opportunities Fund. We went out to banks and convinced them at a time when credit was hard to get to put a TRS in place.
Total return swap, TRS. Okay. And he's partnered up with 2 Apollo guys, giving him direction. And I've already read about both of those guys, Darren and Tom. I even had Tom on one of my tags earlier today. That just goes to show you they never get removed from Apollo. They still follow whatever Apollo's doing during these economic woes. They're going to dive in with them because money follows money. And the truth is, Apollo's just tentacles out to the rest of the world.
To give us leverage against buying first lien positions in companies that we knew were high quality and would recover, but were heavily COVID affected. So we quickly pivoted away from companies that were cheap, that weren't going to be affected by the crisis, to very high quality companies that were affected by the crisis. And those credits were still cheap. But if you think about things around sports, or, you know, things around like high quality must-do conferences in person where people actually did do business and will continue to do business, or, you know, certain elements of media that required gathering of people.
Listen to that. This is, guys, I got to play it for you because you got to hear it again. What they focused on during the pandemic and what they got away from. They went away from things that were sure things, that they thought were sure things, where they tried to buy GameStop, where they tried to dig them into the ground, and you couldn't because gamers, what did we do? We bought more games. We did it via e-commerce. We did all those. But companies they avoided were ones that required large gatherings. Or that's what they actually went into, I should say, not companies they avoided. So watch this.
Cheap that weren't going to be affected by the crisis, to very high quality companies that were affected by the crisis. And those credits were still cheap. But if you think about things around sports, or, you know, things around like high quality must-do conferences in person where people actually did do business and will continue to do business, or, you know, certain elements of media that required gathering of people. You know, we just went very big into these areas, and our view was, you know, because of the back leverage we had, we could earn extraordinary returns. And if these positions continued to trade down, we would just take off the back leverage, and then we'd go loan to own.
Yeah.
And we expect, and we put on about 30 of these positions, put hundreds of millions of dollars behind this. And we would have expected, if you asked me today, that 2 or 3 of those would have become really interesting distress for control opportunities where we'd put another few $100 million behind those. That did not happen.
Yeah.
All of these things have roared back. It's been a great return for the fund, and it was a good pivot for us. But again, just highlights how extraordinary this period was. Yeah. And then, by the way, simultaneously, our portfolio roared back, and we went from, you know, looking into the abyss to taking 2 companies public last summer.
Yeah.
It's there.
So I'm push pause because I'm going to get you to another part. I just want to tell you guys about distressed credit. There's like two different ways of doing it. One is paper. So I would give you the example of AMC currently trading out their debt for paper, like they're doing, where it's just a paper transaction. Then there's operational. Operational is where they actually get the guys on the board, get them into the position CFO, CEO, and they are transitioning the company in a way. So there's two different ways to do this, to apply pressure on these companies. And you just have to find out which creditor you are, right? I assume when I look at Citadel, they're more of paper. They're not the operational side of it. Apollo is definitely the operational side, where they're tearing people apart from the inside out, and they put the plants. This is all allegedly, of course, but you tell me where I'm wrong on this, and I'm going to show you 4 people on Bed Bath & Beyond's board of directors that are planted so far. And I can look at AMC. We knew what Adam Aron was. If you haven't seen every company he's ever touched in the last 20 years, they are run by Apollo. So it's like, what the hell do I need to tell you? If you see what's happening to AMC and the bad moves they make over time, Bed Bath & Beyond's doing the same thing. And people can tell you whatever they want. No, the restructuring. No. They just cut out everything from their company to survive for $225 million. That's what they gave up. And we don't even know the amount of dilution that's happening on the company, but it wouldn't matter. It wouldn't matter because it's all scripted at this point. They're looking for this outcome. But we'll go ahead and listen to this for a couple more minutes and then we're done.
And use fundamental analysis to analyze the situation. And, that's what helped us a lot in Charter. Yeah. We said, okay, the banking system could be a mess, but are people going to give up broadband in their homes?
Yeah.
I mean, this is a consumer staple, which is critical. We're buying in at historically low multiples. You could never buy a business like this ever in the normal course. Yeah. For, you'd be buying it at 4 or 5 multiple points higher at best. Yeah. And so the margin for error just looked so huge. The underlying product looked so stable. And then the same thing, with this more recent pandemic. We said, what are the chances that this pandemic lasts beyond 2025? So we were able to underwrite in that early period of COVID. A lot of these really good companies, we weren't saying they were going to come back in 22. We were just like, these things might not come back till 24, 25, and the numbers still work. Yeah. And so you just looked at that analysis and you could say, all right, let's divorce from fear and focus on that. And the numbers don't lie. This is really interesting on a risk-reward basis.
It's funny. These guys have the risk-reward basis like built into their head. About 2 years ago, I started making YouTube videos, and I was talking about AMC specifically versus GameStop. And so, GameStop's a great investment because not just us, we're buying it, but I like the company and the leadership and the direction of it. And it takes time, guys. It takes time to pivot. It takes time to transition. And you're still in the cycle where it's expensive to borrow money, yet we have found a way to sit on our stack of money and decide what we're going to do moving forward. That's just GameStop. But what I said what AMC was doing, they were doing a lot of things on purpose to make it look like they're doing stuff, but other than just cash burn, right? The cash burn rates are uncontrollable. And for companies to think and or investors to think that you can just go back to the public and get more money, that's not real. At some point, it does not. The reality becomes the nightmare. And for investors, they've lost thousands of dollars, millions of dollars, if not billions. Now I'm looking at Bed Bath & Beyond that I've been reading and researching, and it's the same way for me. They have allowed this company to do a massive cash burn over the last 2 years. During the worst times when the company should be buckling down and sitting on stacks of cash instead of buying the inventory and spreading themselves thin, they should just sit back and see it for what it is. It's a cycle. And when you can get through it and you're on the other side and you don't owe anybody money and no one's holding you to the fire, then you're okay. But as of now, guys, as of today, and it is March 6, 2023, Shaquille O'Neal's birthday, I'm telling you, Bed Bath & Beyond is infiltrated with Apollo executives. They all have ties. They've all been appointed to Apollo-based companies in the past, and now they're here in front of you. I'm going to run. It's not FUD. Those are facts. No matter what the job they're doing today, they still have the ties to Apollo, and it's all factual. Thank you guys so much. Pay attention to the dots. Connect them, and you might save yourself some money. Peace.